Good day, everyone. My name is Alnasaria Ripolyo. I am Philippine Christian University. My topic today is about Unit 13 Long-Term Financial Resources. So, when our learning objectives is to describe the two sources of long-term financials or financing and their differences, also discuss the principal sources of equity and financing as well as sources of debt and financing. So, when you say long-term financing, this is any source of funding with maturity exceeding 1 year. So, sources, examples are debt financing, equity financing, retained earnings, venture capitals, and private equity, leasing, government grants and subsidies, as well as pension funds and endowments. So, these resources are crucial for businesses and individuals to finance a large projects, investments, and other significant expenditures that requires a substantial amount of money. Let's take, for example, here. Let's focus on two sources, the debt financing and equity financing. When we say debt financing, in definition, debt is a loan that a business takes out and is required to pay back an interest. Equity is ownership or having an ownership in the company. Debt is liability when it comes to balance sheet, while in the balance sheet for equity, it is shown as a shares holders equity. When it comes to its status, debt holders have no ownership and equity holders have ownership in the company's decision making. In return, debt payments are fixed and must be paid on time. Equity payments are not fixed and are paid out of the profit. Debt can be secured or unsecured. In secured, there is collateral security involved, whereas unsecured, there is non-collateral. And equity can be common or further subdivided into common equity or preferred equity. Preferred equity typically has a higher dividend yield compared to a common equity. Debt financing is less likely for investors because they get, or less risky for investors because they get interest and the amount can be received back. Equity financing is more risky for investors because if the company is in loss, they get low or negligible profit. It involves really good examples of debt financings are the loans, bonds, debentures. In instruments, a good examples are the shares. So this table is just showing you the differences when it comes to the criteria of comparisons of ownership, profit, level of profit, management possibilities, return form when it comes to its collateral, what are the risks and what are the loss, and its duration. So in equity financing, as what I said, it's subdivided into common stock and preferred stock. So common stock is the companies can raise capital by issuing a common stock to the investors. So this is a form of equity financing where investors become part owners of the company and may receive its dividend. So let's take for a very good example of common stock is the Apple Incorporation. So an Apple Incorporation is the example of a company that issues common stock. So it is a publicly traded company that is registered and listed in the NASDAQ stock exchange. So when an investor buy shares of the Apple common stock, they become a part owner of the company and are entitled to its rights. So let's say, for example, voting rights. They can vote on important corporate matters such as electing the boards of directors and approving a major policies. So when it comes to its dividends, while not guaranteed, Apple may distribute a portions of its profits to a common stockholder. For instance, Apple has historically paid quarterly dividends to its shareholder. When it comes to its capital appreciation, if Apple stock increase prices or stock price increases over time, each shareholder can sell their shares at a higher price than they paid. So when it comes to its residual claim in the event of liquidation, though it is unlikely for an Apple to do so or to have an event like that, common stockholders have a claim on the company's assets after all its debts, preferred stockholders, and other obligation paid. So let's say, for example, how it really works. Let's say if an investor purchases a share of Apple, a common stock through a brokerage account, let's say you buy, or a shareholder might buy 10 shares of Apple for around $150 $1.50 per share. So that is investing $1,500. If Apple's stock price rises to 200 per share, the investor's holding would now have $2,000, representing a capital gain of $500 because they gain 50 for each. So 50 times 10, that's 500. If Apple declares a dividend of 0.50 per share, the investor would receive $5 in dividend. That is because you have 10 shares and you just have to divide it to 0.50, which is the dividend share. So when it comes to risk and reward, common stockholder bear a highest risk in the company's performance. If the company does well, they benefit from the dividend and stock price appreciation. However, if the company loses or a company performs poorly, they may lose their investment. So there is no fixed dividend when it comes to common stock. Unlike the preferred stock, common stock dividends are not guaranteed and depends on the company's profitable and management decision. When it comes to liquidity, common stock is typically highly liquid, meaning it can easily be bought or sold on stock exchange. So in preferred stockholders typically have a higher claims on the assets and earnings. They receive dividends before the common stockholder and have a priority event in when it comes to liquidation. So how it really works, let's say for example, if a investor purchased 100 share of the Bank of America, the preferred stock is $25 per share. So that is $25 times 100, that is $2,500 per share. The preferred stock pays a fixed annual dividend, let's say for example 5%. So the investor would receive 125 per share because 1.25 comes from the 5% of the $25 that you share, and then you have 100 share. So in total or in a year you have 1.25, and then you multiply that to 100 shares that you purchase. So that is around $125 per year. And that paid in quarterly installments. So if it's paid in quarterly installment, that is around 125 divided by 3, that is $31.25 quarterly. If the stock is callable, for example, when you say callable, let's call it off. The Bank of America decides to call it off, let's say 5 years. The investor would receive, because you have $25 per share, so that times 100 is 2,500. So regardless of the market value or the price at that time, you will be receiving the $2,500. If the stock is convertible and the investor chooses to convert, they could exchange their 100 shares to, let's say, a 500 common shares. Pwede siya maging common shares. The key characteristic of preferred stock is at lower risk comparing naman to common stock. Preferred stock is less volatile and it provides more stable income. And when it comes to priority in dividend and liquidation, preferred stockholders are paid dividends before the common stockholders and have a higher claim and a higher asset in case of liquidations happens. So limited upside potential. Unlike common stock, preferred stock does not benefit significantly from the company's growth. Its value is more tied to a fixed dividend. So if the company grows, the stock grows, yung dividend mo, yun na lang talaga, yung share mo, yun lang talaga. It's a fixed dividend payments. Preferred stock acts like a bond or fixed income, is what I said, an equity, making it attractive to an individual who is an income-focused individual. So next is debt financing and other forms of long-term financing. So it is divided into bonds and long-term loans. So Bonds is a companies or government can issue bonds to raise a long-term capital. Bondholders lend money to the issuer in exchange for periodic interest payments and the return of bonds face value of maturity. Um, Take for an example, how does it really work for bonds? So let's take US Treasury bonds as an example. US Treasury bonds are long-term debt securities issued by the US government to finance its operations and its projects. They are considered as one of the safest investments because they are backed up in full faith with the US government. So let's say, for example, the US Treasury 30-year bond. The face value, or what they call the par value. The face value of US Treasury bond is typically $1,000. So this is the amount the bondholder will receive when the bond mature. When you say bond mature, this you have what you call the mature they have what you call the maturity bond. The maturity date, I mean the bond has a maturity date, which is the date when the principal amount or the face value will be repaid to the bondholder. For a 30-year treasury bond, the maturity date is 30 years from the issue date. And bond also has a coupon rate. A coupon rate is just stating it is a fixed interest rate. So let's say, for example, a 30-year treasury bond might have a coupon rate of 3%. This means that the bondholder will receive 3% of the face value annually in interest payments. So the bond pays an interest semi-manually. Take for example a 1,000 bond with 3% coupon rate. The bondholder will receive 15 every 6 months because the bond pays interest, let's say, semi-annually or bi-manually. So 1,000 divided by 1,000 times 0.3%, 1,000 times 0.3 or 3% divided by into 2 because it's bi-manually. You will have $15 every month. $15 every month because it's 3%. When it comes to the market price of the bond can fluctuate. It is based on the change in interest rates and credit worthiness of the issuer. However, that's why in the US Treasury bonds are highly liquid and can be bought and sold in the secondary market. How about long-term loans? These are loans from a financial institutions that have a repayment period of more than 1 year. They can be issued for a various purposes such as purchasing equipment and expanding its operation. It could be also used in its state purchases or a large capital projects. So there are many examples of long-term bonds. We have mortgage loans, student loans, car loans, and equipment loans. So how does it work when you do your when we make long-term loans? So let's take for an example, a borrower, let's say a business term, we do a business term loan for an expansion. So a borrower here, an ABC Manufacturing Incorporation, wants to expand its production facility to meet the growing demand. The loan amount of the ABC, they apply for around $5 million. But this is actually quite cheap or less if you really try to imagine a really big company doing a long-term loan. But let's just take $5 million as an example. So long-term loan of $5 million from a commercial bank. The loan has a term of 10 years. Lahat naman talaga ng loan meron siyang term. So here, let's say 10 years, meaning the company will repay the loan over a decade. The interest rate, again, lahat din naman talaga ng utang, there is an interest rate. Let's take for an example, the interest rate or the fixed interest rate is 6% per annum. This means that the company will pay 6% interest in the outstanding principal per year. And we have a repayment schedule, or let's say monthly installment over the 10 years. So each payment, including both the principals and the interest, using a loan amortization schedule. So the monthly payment would be approximately, if you take or if you loan 5 million over, and you have to pay it for 10 years, and the interest rate is around 6%. I already solved here. It is around 55,506 monthly installment. And that's including the principal amount and the interest amount. Collateral. The loan is secured by a company's assets, such as a new production facility and existing machinery. This reduces the risk for lender and may result in a lower interest rate for a borrower. The loan, for its purpose, the loan is specifically used to finance a construction, is what I said. Also, in a long-term loan, they have what they call the covenants. The loan agreement includes certain covenants, such as maintaining a minimum debt to equity ratio and providing a regular financial statement to the bank. So that is included in their parang in their agreement. So, in summary, each of these long-term financial resources has its own advantages and disadvantages, and the choice of which to use depends on the specific needs and circumstances of entities seeking funding. For example, equity financing does not require repayment but dilutes ownership, while debt financing requires repayment with interest but allows the borrower to retain its full ownership. In summary, common stock represents ownership in a company and provides an investor with the potential for capital growth and dividends, along with the voting rights. Preferred stock is a long-term financial resources that provides investors with steady income and priority over a common stockholder, but it is typically lacks voting right. It has limited capital appreciation potentials. Companies like Bank of America use preferred stock to raise capital while offering investors a safer income generating investment option compared to a common stock. Bonds are a long-term debt instrument that provides investors with regular interest payments and the return of principals at maturity. They are the key components of diversified investment portfolio, offering a balance of income, safety, and liquidity. Long-term loans provide borrowers with the necessary funds for significant investments and are repaid over an extended period of time. They offer predictable repayment schedules and can be secured or unsecured depending on the borrower's credit worthiness and the purposes of the loan. So I'd like to thank you for listening. So I hope you somehow learned from the report. Have a great day, everyone.